One unfiled form costs a retired couple about $4,200 a year. Not a scam, not a penalty for wrongdoing. A surcharge on their Medicare premiums calculated from income they no longer earn. Here is what makes it dangerous. It is deducted automatically from every Social Security check, month after month, and it does not stop on its own. A couple who retired last year, whose paychecks vanished, can still be billed as if they were pulling six figures. The system looks backward, and it does not blink. That raises a question worth holding on to for the next 20 minutes. Why does the government keep charging retirees for income they stopped earning? And who, exactly, is supposed to notice before the money is gone? Because nobody is assigned to notice. There is no letter that says you've overpaid. What follows is the exact arithmetic, how the surcharge is built, how the $4,200 accumulates, and the one document that resets it. The form isn't the one everyone talks about online. It's the opposite kind, and it has a name. Search "increase your Social Security check," and the internet hands back the same advice, over and over. File a restricted application, suspend and restart your benefit at 70. Claim on a spouse's record first. The promise is always the same shape. One clever filing, more money every month. Most of that advice is real. It's also, for the document this video is about, the wrong document entirely. Give the popular version its full due first. The people repeating it aren't lying. Delaying Social Security genuinely raises the check, roughly 8% for each year past full retirement age, up to 70. The strategies have names, they have IRS and SSA rules behind them, and for the right household, they add up. If the goal is a bigger benefit, those are the levers that move it. But look at what all of that advice has in common. Every one of those moves is about the number on the top line of the check. None of them touches the number quietly subtracted from it. And for a specific band of new retirees, the subtraction is the larger problem. Here is the contrast that matters. Consider two couples who both retired last year with identical Social Security benefits. Say, $48,000 combined for the year. One couple did everything the popular advice recommended and optimized their claiming perfectly. The other did nothing clever at all. On the top line, the first couple looks smarter. But if the second couple filed one form the first never heard of, the second couple keeps more money every single month. The optimization was real, and it was aimed at the wrong number. Because the money isn't leaking out of how much Social Security pays, it's leaking out of how much Medicare takes back. That's the document, not a Social Security claiming strategy. Its name is Form SSA 44, and in the program's own language, it's a request for reduction of an income-related monthly adjustment amount, a life-changing event appeal against a Medicare premium surcharge. It is not famous. It is not on the viral lists. And the Social Security Administration reports that only a small fraction of the people who could file it ever do. Ask why almost no one files it, and the answer is uncomfortably simple. To file it, you first have to know you're being charged. The surcharge doesn't arrive as a bill with a warning label. It arrives as a slightly smaller deposit, the same check, minus an amount most retirees never itemize. There's no line that says you are overpaying. There's no agent whose job is to flag it. The form exists precisely because the system assumes you'll catch the error yourself, and then makes the error almost invisible. So the real question isn't whether SSA 44 works. For a qualifying household, it works mechanically, by rule. The question is why it needs to exist at all, why there's a surcharge waiting to be appealed in the first place. And to understand the form, you have to understand the charge it reverses. That surcharge has a name too, and it's built on something strange. Your income from 2 years ago. That surcharge has a name, IRMAA, the income-related monthly adjustment amount, and its most important feature isn't the amount, it's the calendar. Follow the timeline, because the timeline is where the trouble lives. When Medicare sets a person's Part B premium for a given year, it doesn't ask what they earned that year. It can't. The year hasn't finished, so it reaches backward to the most recent tax return it has on file, and by rule, that return is 2 years old. The premium a retiree pays in 2024 is calculated from the income they reported for 2022. Hold that gap in your head, because everything hinges on it. 2 full years sit between the income being measured and the premium being charged. For a worker whose salary is roughly flat, That lag is harmless. Last year looked like this year, which looks like next year. The rearview mirror shows the same road behind as ahead. Now watch what happens at the turning point everyone in this video shares, the year the paycheck stops. Consider a couple in their final working year, 2022. 2 salaries, maybe a bonus, a combined income comfortably into 6 figures. They file that return like any other. Then, in 2023, they retire. The salaries end. In 2024, their income is Social Security and modest withdrawals, a fraction of what it was. On paper, they are now a middle-income household. But Medicare isn't reading the 2024 paper, it's reading 2022, and 2022 was their highest earning year on record. This is the mechanism, stated plainly. IRMAA sorts every enrollee into brackets by modified adjusted gross income, and each bracket above the base carries a higher surcharge on both Part B and Part D. The couple's stale 2-year-old income lands them in an elevated bracket. So the system does exactly what it was built to do. It charges them the premium that matches a worker who is still working. It is not a mistake in the software. The software is functioning perfectly. It is charging them for a version of themselves that no longer exists. And here is the quiet cruelty of the design. The lookback isn't a bug someone forgot to fix. It's deliberate. The government uses 2-year-old income precisely because it's the most recent figure that's fully filed, verified, and final. Fresh income is a moving target. A completed tax return is a fixed one. So the program trades accuracy for certainty. It would rather bill you from a number it can prove than from a number you claim. For most enrollees, most years, that trade is invisible. For the newly retired, it's the whole problem. Notice what the system assumes to make the math work. It assumes last year's income continues into this year. Built into the calculation is a silent bet that your earnings are stable. For a new retiree, that bet is not just occasionally wrong. It is almost always wrong, and wrong in one direction, the direction that costs money. Their income didn't drift, it fell off a cliff on purpose the day they stopped working. The single event that defines retirement is the exact event the lookback is structurally blind to. Which is why a correction has to exist at all. The program knows its own rearview mirror lies for this specific group. That's the entire reason there's a form, a way to tell Medicare, in effect, look at who I am now, not who I was 2 years ago. So the surcharge isn't the accident. The surcharge is the rule. The accident is that almost no one reverses it. So put real numbers into the machine and watch what falls out. Not a scary hypothetical. A plausible couple run through the actual brackets. Meet them as a composite. 2 workers, both 65, who retired at the end of 2023. Their final full year of work, 2022, was ordinary for a dual-income household near the end of a career. Combined modified adjusted gross income that year, around $200,000, 2 salaries, a modest bonus, some investment income, nothing extravagant. Just a household at peak earning, filing one last high return. Then they stop. In 2024, their income is Social Security plus careful withdrawals. Call it $80,000 combined. By any honest measure, they are now a middle-income retired couple. But 2024's premium is read from 2022's return. And $200,000 for a married couple filing jointly clears the first IRMAA threshold and lands them in an elevated bracket. Here is what that placement hides, because the base premium isn't where it hurts. Everyone with Part B pays the standard premium. In 2024, that base was $174.70 per person per month. A couple at genuine middle income pays that, and only that, but their stale bracket adds a surcharge on top, roughly $69.90 per person per month, for Part B alone, in that first tier above the base. That's the number the top-line premium quietly conceals. Now run both scenarios side by side, which is the only way to see the gap. Scenario 1, the corrected premium, the one that matches who they actually are in 2024. 2 people, base Part B, no surcharge. That's their honest cost. Scenario 2, the default premium, the one Medicare charges automatically, from 2022. 2 people, base Part B, plus that Part B surcharge each. And IRMAA doesn't stop at Part B. The same bracket triggers a Part D surcharge too. In that first tier, roughly $12.90 per person per month layered onto their drug coverage. Added up honestly, the Part B surcharge, about $69.90, times 2 people, times 12 months, roughly $1,678 for the year. The Part D surcharge, about $12.90, times 2, times 12, roughly $310. Together, near $2,000 in surcharges the corrected couple would never pay. If that number surprises you, the like button is the quiet way to tell YouTube that more people approaching retirement should see this before their first premium is set. Now, the hook named $4,200, not $2,000, and the reconciliation is honest, not a walkback. Push the composite's final working year up to the next bracket, which a couple with 2 strong salaries and capital gains from selling a house or rebalancing a portfolio can easily hit, and the Part B surcharge per person jumps to roughly $174.70. The surcharge alone equals a second base premium, while Part D climbs in step. Run that tier for 2 people across 12 months, and the annual gap lands right around $4,200. Same mechanism, 1 bracket higher. The number in the hook isn't the floor, it's a realistic middle. Sit with the smaller, more conservative figure for a moment, because even that one is enough. $2,000 for people whose actual income is $80,000, charged on the strength of a salary that no longer exists. Not a fine, not a mistake in the code. A premium calculated correctly, from a version of them that retired 18 months ago. The corrected couple and the default couple are the same couple. Same age, same address, same real income, same Medicare. The only difference between them is which year the computer is reading, and whether anyone told it to read the right one. That's 1 year. And here is the part that turns a nuisance into a number worth 5 figures. The default doesn't correct itself the next year, or the one after. Start with a question the program's own numbers answer badly. Of every retiree who qualifies to appeal, how many actually do? The honest answer is that almost none of them file. And the reason isn't laziness or ignorance. It's that the correction was designed to be voluntary in a system where nobody is told they qualify. Think about what voluntary means when the trigger is invisible. A retiree can only file SSA 44 if they know 3 things: that a surcharge exists, that it's being charged to them specifically, and that their income drop counts as a life-changing event under the rules. Miss any one of those, and the form never gets filed. The Social Security Administration's own reporting on income-related adjustments shows that the population paying an IRMAA surcharge is large, and the population that successfully appeals one is a small fraction of it. The gap between eligible and filed isn't a rounding error, it's the whole story. And the gap persists for a reason that has nothing to do with the retiree's intelligence. It's structural. The surcharge arrives as a slightly smaller deposit, not a labeled bill. The appeal requires a form most people have never heard named, and the window to act quietly rewards the people who happen to already know, which, for a rule this obscure, is almost nobody. Consider how the 2 couples from the arithmetic actually experience this. They are identical in every way but one. Someone in the first household knew the form existed, not because they were smarter. Because a tax preparer mentioned it, or an adult child managing the transition happened to read the right paragraph. That single accident of awareness is the only thing separating the honest premium from the inflated one. The system doesn't reward diligence. It rewards prior knowledge, and then hides the knowledge. So the retirees who file are not a random sample of those who could. They skew toward households with a financial advisor, an accountant who handles retirement transitions, or a family member who does this for a living. Everyone else defaults into overpaying, not because they chose the higher premium, but because no one presented them with a choice. The lookback charges automatically. The appeal must be initiated manually. That asymmetry quietly is the entire policy. Which is why the question that matters isn't whether the appeal is worth filing. For a qualifying household, the arithmetic already answered that. The question is how much is actually on the table, because a retiree deciding whether to spend an afternoon on paperwork deserves to know the size of the prize before deciding it isn't worth their time. And here the reflection turns practical. The $2,000 gap or the $4,200 gap in the higher bracket was 1 year. A single year's overpayment, sitting there uncorrected. Most people, hearing a few $100s a month, round it down to a manageable annoyance. Something to fix eventually, not urgent. That instinct is the trap, because the surcharge was never a one-year event. It's a monthly deduction that renews every year. The lookback keeps misreading who they are. And for a couple whose income permanently dropped at retirement, that misreading can repeat year after year until someone finally intervenes. A monthly gap sounds small. Multiply it by the length of a retirement and the number stops being small. A few $100s a month ignored for a decade is not a nuisance. It is a car. Sometimes it is a year of long-term care. The reason the IRMAA overpayment is dangerous isn't the monthly figure. It's what the monthly figure becomes when it's allowed to run unopposed across an entire retirement. Start with the conservative couple, the $2,000 a year version, and refuse to round it down. Suppose their income stays low enough that, absent an appeal, the lookback keeps catching an elevated year for only the first 2 years after they retire, the years still reading their working income. $2,000 twice is $4,000. Gone to a surcharge they never owed on income they no longer earned. And that's the mild case, the one where the mismatch self-resolves quickly. Now take the higher bracket, the 4,200 version, and stretch it the way real retirements stretch. A couple who sold a business, realized large capital gains, or drew down heavily in one transition year can land in an elevated bracket that the lookback keeps rereading. Run $4,200 across even 3 or 4 years before anyone notices and corrects it, and the total clears $15,000. Not theoretical. Just arithmetic, compounded by silence. Here is the historical parallel that makes the scale believable. IRMAA didn't exist before 2007. It arrived with the Medicare Modernization Act of 2003, effective for Part B beginning in 2007, layered onto a program that, for its first 4 decades, charged every enrollee the same Part B premium, regardless of income. That flat structure was simple, and, for the newly retired, forgiving, your premium never punished you for a salary you just stopped earning. The change traded that simplicity for means testing. And like most means tests bolted onto an existing system, it inherited the machinery already in place. Annual tax returns, filed on a lag. The surcharge was new. The 2-year delay was old. Nobody redesigned the calendar to fit the newly retired, because the calendar predated the problem. That's the contrast worth holding. The old system overcharged no one at retirement, because it charged everyone the same. The new system overcharges precisely the people whose income just collapsed, because it reads a number from before the collapse. The policy got more sophisticated and, for this one group, less accurate at the exact moment accuracy mattered most. And the deepening is this: the cost isn't only the dollars deducted, it's the dollars those deducted dollars would have earned. A couple overpaying $200 a month isn't just losing the $200, they're losing whatever a modest portfolio would have done with it over the years. They didn't need it for premiums. The overpayment doesn't sit still. It quietly forecloses the compounding that was supposed to be theirs. The honest lifetime figure for a household that qualifies and never files isn't the $4,000 of the gentle case or the $15,000 of the steeper one. It's those numbers plus the growth they never got. For the right couple, in the wrong bracket, left uncorrected long enough, the total is unambiguously 5 figures. Which raises the only decision this whole reconstruction leads to. File the SSA 44 the year your income drops, or accept a surcharge on money you no longer earn. Which side would you land on, and why? The comments are open. Because the good news, finally, is that the machine runs both directions. What the lookback charges automatically, the appeal can reverse, sometimes retroactively for the year in question. The overpayment is not permanent. It is standing there, waiting to be undone. So the fix is worth chasing, but it isn't for everyone. It turns on a specific test, and not every retiree passes it. So who actually passes the test, and who doesn't? Because the appeal is powerful, but it isn't automatic, and it isn't universal. Before anyone spends an afternoon on paperwork, they deserve the honest boundary of when it works. Start with the door it opens through. SSA 44 is not a form a retiree files simply because their income dropped. It has to drop for a reason the program recognizes as a life-changing event. The list is specific and closed: marriage, divorce, death of a spouse, loss of pension income, and the one that covers most people watching this, work stoppage or work reduction. Retirement is a qualifying event. That is the hinge the entire appeal turns on. No qualifying event, no form. This is why the video never promised it works for everyone. It works for people whose income fell because of something on that list. Now walk through what filing actually looks like, because the mechanics are less intimidating than the rule that hides them. Picture a couple at a kitchen table 11 months after the last paycheck. They pull up Form SSA 44, one page of it that matters, from the Social Security website, or they request it by phone. They check the box for work stoppage. They write in the year their income actually dropped and estimate what it will be now. They attach proof, a letter from a former employer, a signed statement, a recent tax return showing the fall. Then they submit it, by mail, or in person at a Social Security office. That is the whole act: a page, a reason, a document, a signature. Here is the lesson underneath the paperwork, and it's the one the whole video was built to deliver. The system charges by default and corrects by request. It will never volunteer that a retiree qualifies. The burden of noticing and the burden of filing both sit entirely with the person being overcharged. The form isn't hard. Finding out it exists is the hard part, and that, not complexity, is why so few file it. But hold two honest limits, because a documentary that oversells is no better than the viral advice it was written against. First, the appeal requires that qualifying event. A retiree whose income was always modest, or who simply had a good investment year with no life change behind it, does not qualify and should not expect relief. Second, it isn't guaranteed retroactive relief for years long past. The strongest use of SSA 44 is forward-looking and prompt, filed in the year the income drops, or the year the surcharge first appears, where it can reset the premium, and in many cases, recover the current year. The further back the overpayment runs uncorrected, the harder the money is to reclaim. The tool undoes the surcharge. It does not reliably undo a decade of neglect. Which finally answers the question this video has carried from its first sentence: why does the government keep charging retirees for income they stopped earning years ago? And who has to notice? It charges them because the Lookback was built for stable earners and never redesigned for the newly retired. And who has to notice? No one is assigned to. The system waits for the retiree or the family member managing the transition to catch it and file the page that reverses it. That is the answer, plainly. The correction exists, it is real, and it is left entirely to the person losing the money to initiate. The practical instruction is simple, even if the rule was not. If income fell because work stopped, the SSA 44 is the document to look at. The year it falls is the year to file it, and the qualifying event is the thing to confirm first. Wealth is built to last, but only when someone checks which version of you the computer is still billing. File the year your income drops or keep paying a surcharge on income you no longer earn. That is the choice, and it is yours to make. This is education, not personalized advice.